From New York to California, everyone is looking at the peaking prices in despair, watching their lifelong dream of acquiring their own home burn into ashes. 2024 is almost 4 months away, but no sign can essentially indicate that the housing bubble will pop. This once stable market has become highly volatile, plagued by greedy investors, massive property tax, home builders, and flippers. It is the seller's market. By this, we mean that the marketplace favors the sellers, and its course is likely to be determined by them. Every morning, we see an absurd price appreciation and think nothing can be worse than this, and the next day, worse happens. As the bubble continues to expand, the gap between the income limit of an average homebuyer and their debt payment is progressively shrinking. To put it differently, the ratio is consistently increasing. If you look at the index displaying home buyers' debt-to-income ratio over the past few years, you will see a situation we have not seen for decades. The debt-to-income ratio is now officially 40%. It implies that an average homebuyer has to put aside 40% of their monthly income for housing mortgage payments. The ratio is much more than in the previous crash of 2008. This right here is the biggest red flag in terms of affordability. Historically speaking, every time something like this happens, the market does not sustain very well, and soon we will reveal what it means for you and the current market. Please support our channel with a thumbs up, and don't forget to subscribe to our channel. Unarguably, we are in the middle of the most stressful housing market that the U.S. has seen in decades. It was not more than 3 years ago when the market was sailing through the serene waters. Today, as we navigate through it, we find ourselves in uncharted territory. We are seeing an absurd increase in property rates and a record elevation in mortgage interest rates, and it seems like we are nowhere close to witnessing relief anytime soon. Considering massive price hikes in other markets and basic life commodities, a 40% debt-to-income ratio is insane. But there is another factor that we cannot just ignore. Despite this record high ratio, down payments paid for the houses are much less than what we saw before the 2008 crash. Today, an average homebuyer puts down 18% on a mortgage, whereas homebuyers before the last crash used to cater to the down payment of 21%, unless it's an FHA loan that requires only 3% down for first-time homebuyers. So what does this picture look like? Today's homebuyers are putting down less money, using up more, and leveraging at 2006 level interest rates. At the same time, these individuals are expected to believe that the market is going fine and there is no bubble. To deny that we are in some sort of a bubble means blindfolding ourselves to what the stats have been showing. We are all familiar with the restricted supply of houses in the market. This year, we began with almost 40 to 50% fewer houses than in the pre-pandemic era. Consequently, the supply versus price effect kicked in to raise the house rates, but the pain did not end there. The shadow of increased interest rates hovered over our heads. According to the data provided by Insider, the average monthly payment for a house in the U.S. was around $1,600. With the increase in the Federal Reserve rates to 7%, we obviously had to witness an increase in the monthly payments, which have flared up to $2,800 this year for that same house. It accounts for a 75% increase in an average home monthly payment within 3 years only. If this does not look like a bubble, we don't know what does. Given the swirling rumors that the Federal Reserve is not done raising the interest rates, everyone is fearing what the real estate market holds for them next. Everyone is preparing for significant turbulence throughout the remainder of 2023, pondering when this nightmarish situation will come to an end. There is no straight answer to this question because the course of the real estate marketplace is hard to predict. But as much as we hate to admit it, the answer is not going to be what everyone wants. Sure, everyone is praying for the crash, and the internet is filled with theories trying to prove that it is about to happen. The story is not that simple. We might not see the bubble bursting for the next couple of years. It seems that pricing relief is nowhere in our sight. The most common way for analysts to theorize a crash is by the use of history and its patterns. Undoubtedly, historical trends get us some insight, but they are not generalizable to every situation entirely. We have to realize that the housing market is not only under the influence of the factors directly related to it. Several other factors passively brew whatever happens in the market. Today's consequences are far different from what we have experienced in history. Let's put this into perspective using the debt-to-income ratio that we discussed earlier in this video. Unarguably, such a hike in the ratio is concerning, but if you dig a little deeper, you will extract an interesting insight. Forbes advisor has pointed out that the current mortgage holders in America are enjoying ultra-low mortgage rates. Almost 80% of these people invested in real estate before the mortgage rates rose to 7%. Thus, most of them are tied to less than 5% mortgage rates. Look at the data reported by the Federal Finance and Housing Administration. Currently, 14% of mortgage holders have a sub-3% mortgage rates, and 35% have a mortgage rate below 5%. Hold on. Look at this now. Nearly 40% of houses owned are free and clear of mortgages, which means these homes are owned outright and the occupants are paying no mortgage. Do you see where we're going with this? There are very few new homeowners. You must have heard about the decrease in housing market sales in the last few years, so an increase in the interest rates might be concerning. But the number of people acquiring houses at these rates is very low. They make a cohort so small that it has little to no impact on the overall situation. With this pace of the real estate market activity, it is a matter of years or even half a decade for this cohort of people who pay high mortgage rates to grow bigger. Until that point, it's unrealistic to anticipate this number having a significant impact on the market trends one might consider substantial. The situation is obvious. There is no wave of bankruptcies under this crippling debt that can rattle the market for the next couple of years. The fact becomes even more undeniable if you take a look at the graph indicating delinquent loans since the last crash of 2008. The trend has only come down since then. The foreclosures make up a teensy bit of the market today, posing at 1.4%, well below the pre-2020 average. Now, some of you might have heard that the number has increased year over year, and the market might be onto something, but let's not mince words here. It's essential to consider the sudden increase in the context of post-pandemic policies. Bankruptcies were temporarily suspended. Naturally, the noticeable rise that followed had to appear significant. The number was so low in the previous years that any number had to look giant in comparison to it. So, you cannot predict the future only based on this small time frame, especially when the bigger picture suggests something else. In comparison to the past, today's delinquencies are historically low. The buyers are still relatively stable, and the financial stress is apparently low, though many would disagree with this statement due to inflation. There are varying trends in the housing market throughout the country, but the market is still flaring up in most states. Florida, North Carolina, Texas, Tennessee, you name it. The prices have been stable and even increasing in various cities. For instance, look at the trends observed in Austin, Texas. In the winter of 2022, the town was labeled as the epicenter of the crash because the prices had started to plummet. Panic started in true meaning when a house was listed at a 23% lower price rate in February 2023 compared to May 2022. But the way the marketplace has caught up after that makes it evident that the decline was due to a rapid increase in mortgage rates. After that, the seasonality effect also kicked in, and the prices began to rise yet again. Currently, they are only 12% below Austin's historic high. If you look outside of Austin, you will observe a similar trend in prices across other cities too. The prices are nowhere close to climbing down. In fact, they seem poised for a spike up. It hurts to say that the much-awaited crash is still on hold and does not seem likely to happen in the near foreseeable future. From here on, only a serious crisis can change the course of this market. Current mortgage holders lack incentive to sell, while investors are still greedy. At the same time, the supply keeps getting tighter and tighter. Until something critical happens, we cannot see a breath of relief for an average home buyer. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.